Hello and welcome to Earnings Echo. We put together the most important information about Datadog.
We're digging into their Q4 and full year 2025 results. And, this feels like one of those reports that really changes the narrative on a stock.
It really does. So let's jump straight into the quick check. The top line numbers, they're pretty staggering.
Go ahead.
Revenue came in at $953 million for the quarter. That's a 29% jump year over year.
And that sailed right past the high end of their own guidance. It's not just a beat, it's a statement.
Exactly. And the bottom line?
Non-GAAP earnings per share hit 59 cents. The street was only expecting about 55 cents.
So it's the classic double beat.
Yeah.
Beat on revenue, beat on earnings. But here's the thing that gets me. The stock surged, 18%?
Yeah.
That seems like a huge reaction for a few cents on EPS.
Well, it's not just about the beat. You have to remember the context. The stock had been pretty beaten down leading up to this.
Right. There's a lot of negative sentiment, a lot of shorts betting against it.
Precisely. And then Datadog drops a Q1 2026 revenue outlook of $951 to $955 million.
When the consensus was way down at $935 million.
Exactly. So you combine a big beat with guidance that strong on a heavily shortened stock, you get a classic short squeeze. The bears had to run for the exits.
The financial equivalent of a stampede. Okay, so let's move past the stock mechanics and into the business itself. What's driving this 29% growth?
It's broad-based, but the real aha moment in the report for me is platform consolidation.
You mean companies ripping out other tools?
Yes. Large enterprises are tired of juggling 5 different monitoring tools. They just want one platform that does it all. And Datadog is becoming that platform.
I saw that incredible example in the transcript. Management mentioned a record-breaking, an 8-figure annualized deal.
That's the one. Think about that for a second.
One customer is paying them over $10 million a year. That's a massive, massive vote of confidence.
It is. And look at who it was. A major AI financial model company. They replaced 5 separate tools, some commercial, some open source, and just went all in on Datadog.
That proves the whole thesis, doesn't it?
Yeah.
That at a certain scale, doing it yourself with free tools is actually more expensive.
It's the cost of complexity. And speaking of costs, their own are incredibly well managed.
You saw the cash flow statement. $291 million in free cash flow.
That's a 31% margin.
Yeah.
And their gross margins are still holding strong above 81%.
So we always talk about the rule of 40 in software growth rate plus profit margin.
Right.
Datadog is growing at 29% and has a 31% margin. They're basically operating at a rule of 60.
Which is incredibly rare. That's the kind of efficiency that justifies a premium valuation. You're getting high growth and high profitability. Usually you have to pick one.
Okay, so we have to talk about AI. Is Datadog a real AI play? Or is this just, marketing buzz for the algorithms?
The data says it's very real. They have 650 AI native customers now. They're becoming the essential infrastructure for the AI companies.
And I saw that stat on their Bits AI agent. The tool calls for it grew 11x just in Q4.
That, to me, is the key echo from this report. That's not buzz, that's rapid, tangible product adoption. Over 1,000 customers are now using their observability products specifically for their AI workloads.
It's a pick and shovel play on the whole AI boom.
A very profitable one.
So looking ahead, management sounded confident on the call, but CFO David Obstler has a reputation for being pretty conservative with guidance, doesn't he?
Legendary for it. And you can see it here. The full year 2026 guide is for about 18 to 20% growth. But, and this is the key part, Obstler explicitly said on the call they modeled that growth excluding their single largest customer.
Wait, hold on. So they basically assumed their biggest client might drop to 0, and they still guided for nearly 20% growth.
Essentially, yes. They are baking in a huge buffer. It's a very prudent way to guide, and it tells investors there's very likely upside to those numbers.
That's the kind of sandbagging Wall Street loves to see, and the retention numbers seem to back that up.
Absolutely. Gross retention is stable in the mid to high 90s. Net revenue retention is still around 120%. Customers aren't leaving, and the ones who stay are spending more.
So to wrap this up, we have a double beat, a short squeeze, massive enterprise consolidation, and a company operating at the rule of 60 with a very conservative guide.
It's really hard to find a hole in this quarter. They're cementing their position as a critical, non-negotiable part of the modern tech stack, especially for AI.
A truly fascinating breakdown. It's always amazing how much of a story you can find inside a few spreadsheets. That's all for our deep dive today.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prep. Catch you again soon.